In our Jackson Hole video, we warned that the Fed would keep on raising interest rates till inflation dropped. On Wednesday, 21st September, Powell stuck to his Jackson Hole speech. He raised the main rate by 75 basis points, as expected. And he now brought the Fed funds rate to a range of 3 to 3.25%. In our previous video, we warned that rates would stay higher for longer, and this is now going to take place. New projections from officials yesterday have shown that a median estimate of 4.4% at the end of 2022 for the Fed funds rate, and a rate of 4.6% by the end of 2023, before the Fed start easing off interest rate hikes. The dot plot now shows a 10-9 majority in favor of hiking above 4.25% this year, suggesting a fourth straight 75-point basis hike increase in November. Policymakers now expect rates will be cut in 2024 to about 3.9% and to 2.9% in 2025. GDP growth forecasts have been marked down to 1.2% in 2023 and 1.7% in 2024, below the longer run trend. And unemployment is now seen rising to 4.4% in 2023. Now, why is the Fed so insistent on bringing this inflation down? One thing that no one talks about is this. The Fed made a mistake in 2021, thinking that inflation is transitory due to the COVID-19 pandemic. And they did not start raising rates slowly, because of this assumption. And when inflation surged to 9.1%, the Fed panicked. Inflation peaked at 9.1% in June, but it has not come down quickly. And the last reading in August was at 8.3%. The Fed wants inflation to come down to 2%, which is a very tall order, in our opinion. Now, Powell has made it very clear. He says higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and having to come back and do it down the road again. So to him, price stability is very, very important. He says, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. He also warns that he wants to avoid prematurely easing, and he wants inflation to come down to 2%. And he says, we will keep at it until the job is done. Now, on the back of this raising yesterday, the S&P closed below 3790, down more than 10% in the past month, and 21% off its 52-week high. Futures are trading right now at 3766. Now, major support is at 3006, where the S&P trades at only 15 times forward earnings. In this scenario, what can investors do until the market stabilizes and the Fed eases off? Number one, like we have said before, buy the US dollar. Whenever stocks drop, the US dollar goes up. And US dollar has been the best performing asset since March, when the Fed started to raise interest rates. Number two, buy inflation-resistant companies. Buy inflation-resistant sectors and companies. Let me give you an example. The biggest US health insurer has climbed 170% since 2020, while a top-class biotech company has surged 50% in the same period. One of the biggest packaged food companies in the US has climbed 40%, while an electric vehicle battery maker yesterday surged more than 17%, and it has already surged more than 100% over the past 6 months. For the first time in 15 years, investors can get nearly 4% yield on US Treasury bills. This benefits companies like Berkshire Hathaway, Apple, Alphabet, and Microsoft. Now, besides buying companies that are inflation resistant and making money every single day, investors should also buy a hedge that will make you money when the stock market drops. To let us help you navigate through these volatile markets until they stabilize, let us show you how you can keep your investment safe and preserve your paper losses. Contact us now at bit.ly/algotrader and subscribe to our YouTube channel at bit.ly/algowealth.